rethinking where we are on rates, on oil, on bankers' pay, and on the Biden administration. This is Bloomberg Wall Street Week. I'm David Weston. This week, Bank of America CEO Brian Moynihan on the move to digital banking.
It makes us tremendously efficient and a great client experience, which is a pretty good thing.
Special contributor Larry Summers on growth in the face of rising rates.
I think the gravity of our situation is still understated.
And former Qualcomm CEO Paul Jacobs on the semiconductor chip shortage.
We had some shocks in the system, which became big when there were flips in the supply, which happened because of COVID. These things spiraled out of control.
It was a week for taking stock as President Biden tried to reset his agenda after a year in the job.
But I'm not going to give up and accept things as they are now. I call it a job not yet finished.
And admitted that he wasn't going to get all of that Build Back Better package, at least not all in one piece.
I think we can break the package up, get as much as we can now, and come back and fight for the rest later.
Oil markets took stock of where they are, sending the price of Brent crude up over $89 a barrel at one point, with talk of it maybe going to $100 a barrel. Here's Amrita Sen from Energy Aspects.
I think the fact that demand is so strong and refining margins in particular are still very, very robust despite the crude rally we've seen is a very promising sign.
The big banks revisited their pay scale and pretty much agreed that they needed to raise the bar.
You have to pay people. We don't want people want to work for less next year.
But when it comes to taking a fresh look, equities led the way, suffering the worst week since the pandemic roiled the markets, with tech shares leading the way down, helped by uneven earnings and the anticipation of higher rates, with the S&P down 5.6% for the week and the Nasdaq down another 7%, putting the index into correction territory. For all the talk about rate hikes, the 10-year bond yield actually went down 2 basis points to 1.76, while the dollar climbed nearly 0.4%. To help us sort out a very volatile week, we welcome now Sarah Ketterer. She's CEO of Causeway Capital, and Ann Sonders. She's Chief Investment Strategist at Charles Schwab. So as a strategist, we've got to turn to you first, Ann. What is going on here with the markets? Is it the rates anticipation? Is it the earnings? Is it something else?
So there may be a little bit of a tie into earnings just in terms of the companies that haven't beaten expectations have gotten hit a little bit more. But I think there are bigger picture issues here. It's the combination of the Fed having moved from very loose policy to tighter monetary policy, whether or not what they will start to do with rate hikes, ending tapering, and then potentially moving to QT is the elixir for what ails us in terms of the inflation problem, which in turn is putting downward pressure on growth. And I just think you have a re-rating going on and certainly a bit of a, excuse the term, puking of some of the higher spec, lower quality segments of the market.
So, Sarah, puking, a technical term I hadn't heard before, but what are you seeing as an investor? What are you seeing there? What are the opportunities? What are the real risks out there in the marketplace right now?
Well, the market is certainly rewarding certain areas such as energy and financials, banks, insurance stocks, but and value indices are outperforming growth by a wide margin. And this is just 3 weeks into the year. But if you look beneath that, as Ann noted, there definitely is pain associated with the extremely high valuation stocks. But not all the very low valuation stocks are doing well. Again, the market seems to be rewarding those associated with rising commodities. And the financials, maybe the value indices are pulling up some of the financials. They have some, I think, serious headwinds. But the area that might have the greatest amount of upside as the market begins to discern the winners and losers in this, as we move toward post-pandemic, will be those who are most badly affected by COVID. And there's a whole range of those stocks that have outperformed thus far and should continue to do so as the year progresses.
Yeah, and David, I think what Sarah said is absolutely right with regard to sort of the push and pull of energy and financials, and then the relationship that has with the value indexes. But what's also interesting is a lot of times when people talk about growth versus value and value doing well, they're thinking about it at the index level. But even in a sector like technology, over the past few months, those stocks within tech that screen well on value characteristics like free cash flow yield, dividend yield, are the ones that are outperforming, whereas the stocks within tech that have negative earnings are the ones getting hammered. So even within, call it growthier segments of the market, the value-oriented stocks are the ones that are doing better.
Yeah, we even see this within semiconductors. You can see an incredibly expensive semiconductor stock like an NVIDIA underperform maybe a less expensive stock in memory. So the distinction is happening right before our eyes, and it's a reason to be grounded portfolio-wise in reasonably valued, higher quality companies.
Liz Ann, insofar as there's uncertainty in the market right now, are we going to get some help from the Fed next week? We're going to get another FOMC ruling.
So it'll be an interesting meeting. I don't expect anything particularly formal in terms of what they're going to do. They're not going to start to raise interest rates. Maybe in the statement they give a little bit more color about tapering, but there's no question that during the press conference, I'm sure Jerome Powell is going to be peppered with questions about the span of time between tapering and QT, whether or not they're going to have to act with a faster pace, or a lot of chatter today, might they have to do 50 basis points in the early stages versus only 25. So I don't expect much of any of that to be in the statement, but given that every FOMC meeting has a press conference, those these days I think are even more interesting than when we first hear at 2 o'clock Eastern.
And what we can't, this is so interesting that the Fed, nor can the Bank of England or the European Central Bank, they can't ignore what's right in front of their face, which is inexorable wage increases. That every company we talk to, and companies we don't talk to, we just read transcripts, they are facing wage inflation, and wage inflation begets more. So wage rises beget more wage rises, which was what makes inflation somewhat difficult to eradicate. So central banks may very well be behind the ball here.
Well, I want to pick up on that, if I could, Liz Ann. Inflation would be difficult to eradicate. We know that the track record of the Fed in dealing with this, a soft landing, is not that great. Are we underestimating the difficulty? Because if you look at things like financial conditions right now, they have not tightened that much. If you look at 5 years, they're still around 2.12 or something.
Not only that, but we haven't seen a blowout in credit spreads. All of those would also be the factors you want to keep a close eye on to get a sense of when this is starting to bite to a more significant degree. But you're right, it is always, even in a normal environment, difficult for the Fed to land the plane perfectly, and engineer that soft landing versus a recession. And I think with the added kicker of inflation that's much more rampant and much higher than in the past several cycles, at the same time, we have the virus and the implications that has had on global supply chains and demand, and how unique the uncertainty is with regard to that. I would argue it's probably even harder for the Fed to engineer a perfect soft landing.
And what's even so fascinating is this is like no other cycle. We've never seen $30 trillion globally of both fiscal and monetary stimulus get pumped into an economy in a year and a half. I mean, that's insane. So that's why it's very difficult for all of us to determine what's next. And all we can do as portfolio managers is ensure we have the best companies we can possibly own for our clients at the most reasonable valuations, because that's where the protection is in a rising rate environment. And then those that are likely to benefit from what has been a very significant setback, namely the pandemic.
Sarah, is cash an alternative right now?
I don't think so. And our clients don't want us to hold cash because there is no return to it. And it may be some time before, after shrinking Fed balance sheets, and maybe then the next step for the Fed is to raise rates. But right now there is no return to cash. And there are markets overseas where the return is still slightly negative.
Liz Ann, Sarah makes a really good point. In fact, there's still monetary stimulus going to the economy. They're still buying bonds. They're just buying fewer of them right now. We actually haven't come off of that stimulus yet.
You're right when you look simply at whether the Fed is still adding to the balance sheet. But if you look at a broader measure like M2 money supply, the year-over-year growth rate in M2 actually peaked a year ago and has been coming down quite substantially. So this sort of liquidity drain is not some brand new story. It just becomes more overt when you've got the Fed actually with its balance sheet and rate hikes moving toward tighter policy.
Thank you so very much to Liz Ann Sonders of Charles Schwab and Sarah Ketterer of Causeway Capital Management. Coming up, Bank of America Chair and CEO on the future of digital banking. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The move into digital was a big part of the earnings announcements of the big banks this season, with projections of large investments dampening profit expectations in the near term. Bank of America Chair and CEO Brian Moynihan has made digital a priority for years now, and he's not backing off, seeing it as a major component of the bank's future.
In the broadest strokes, we are a high-touch, high-tech company, so digital is part of the strategy, but it has to be incorporated with our relationship management businesses, think the private bank or Merrill or the commercial bank or the trading businesses. So, and also all our branches, 300,000 or 400,000 people come into our branches. So it's a combined strategy. But why digital is so important, it's from the customer interface, it's from how employees can work together, and then how the customers can receive the goods and services, how they buy them, how they interact with us. So it makes us tremendously efficient and a great client experience, which is a pretty good thing.
There's a lot of talk right now about particularly the big banks investing in digital. I know you've been investing for some time. I think your number is around $3.5 billion a year. Is it as steady as you go? Do you expect that to continue into the future or ramp up?
Well, it's always changing as to what we spend it on. It's a gross amount of money, which is a pretty good size amount of money. So when people talk about $3.5 billion for us, that means literally incremental new products and services and new capabilities. So it's a lot of money. To run the platforms, another $10 or $12 billion. It just goes on every day. But what are we investing in? Greater capabilities. So Erica, to our consumer clients, is huge, but we can keep increasing the functionality. So year over year, we had a fourfold increase in the fourth quarter of 20 versus 21 of people using Erica, not because Erica it had a growth in customers, but really came from people using it more and more. Or in Zelle, getting it more easily accessible through a widget that's called. Those are the types of things we're doing. And then on the institutional side, Cash Pro, which is the way companies move money, 240% more engagements by customers. They can see everything in a portal-type app as opposed to a bunch of different systems. These are just core executions we drive through the platform.
I believe you passed a roadmap, Mark, this actually quarter in Zelle actually having more transactions than your checking accounts do. I believe I read that. If true, give us a sense overall in your business. Will that continue to progress? I mean, at some point, does digital eat the entire bank?
Well, so what happened with Zelle is we keep track of the checks written by our customers. So you sitting down and writing a check out and handing it, putting it in the mail to pay a bill or to hand it to somebody, that's down 24% over the last couple of years. And Zelle's been growing 50 to 100% a year. So the numbers of transactions by Zelle is actually exceed the number of checks written by our consumer customers. That was a milestone because it shows you what's really happening is that Zelle is eating into those low balance checks. And so if you look at the dollar amount of checks written, not the number of transactions, the dollar amount's actually up a little bit. So less checks of higher amounts to $2,000 checks versus $20 checks, and those low checks are being taken over by Zelle, which is good because it's easier for the clients to move money to each other. It's easy instead of giving your son or daughter a check, David. You just Zelle them the money, and the volume of Zelle now exceeds Venmo overall in the industry, and I think we're basically equal to Venmo in terms of transactions on a quarterly basis. So we're driving that through, but it's really convenient. But that is a big milestone to think that what you and I grew up with, David, is the way to get money out of the bank was to write a check and hand it to somebody, and then they could negotiate that check, has now gone to where you can just say, give me your cell phone number, and you pay them. That's pretty good.
It's extraordinary development, certainly for somebody of my age. That's right, Brian. Give me a sense, as you look at the digital strategy going forward, how much of this is basically doing a form of the business you've been doing, for example, Zelle replacing checks, as opposed to actually moving into new businesses, potentially with new customers?
Well, I think if you look on the wealth management business, the financial advisory team we have at Merrill and the private bankers we have, they're core to what we do for clients. But if you think about what happened during the pandemic, the ability for us to get information to clients and deliver our insights to clients through Zoom and WebEx and other types of meetings allowed us to get out to clients in a very intimate setting, one-to-one, but through the screen many more times. So you enabled your reach of those teammates, but behind the scenes also just think of the investment products. Like our life events investment product has 7 million users now who are loading in a financial plan, a life event plan for them, and it keeps them on par and moving forward on task, showing them what's happening. If they save this much, they want to save for this purpose. What are their priorities? Is that a new product? No, an advisor did that for years. But is it enablement to allow an advisor to add more value to the insight and knowledge they have, as opposed to putting the stuff in a financial planning module or doing calculations on spreadsheets? So, as you think about these, yes, some are very new products. Zelle's a new way to move money. Others are, digital embodiments of old products, but allow you to have reach and access and capabilities far different. And that's pretty fun and interesting.
Are there customers that you will reach through digital that you would never have reached through Bank of America? Or is it basically that customer base that, of course, you're always trying to grow?
Yeah, we have basic things. We have more we can do with every customer because we have the best capabilities of anybody in the market. And if a customer simply has a product with us and does something with somebody else, we're not serving them well because we're the best, therefore they should do it with us. So that's our basic principle. But on the other hand, we can gather customers. So if you think about it in the consumer side, especially as we've been going into new markets, say Pittsburgh or Columbus or Cleveland, Cincinnati or Salt Lake or Denver or Minneapolis, that we've opened up in with branches. When we go in there, we go in digital first, and we'll have 10, 20,000 checking accounts going before we ever open the first branch. So those customers can work with us completely digitally, and it works. And so, but we firmly believe it's a high touch, high tech. At some point, most customers on the consumer side come to the branch. All the relationship management customers, the core interface is through a person, a financial advisor, a commercial banker, but enablement helps. And so you have to think about this as a combined strategy of high touch, high tech. So yes, we get customers digitally only. That happens all day long. But at the end of the day, what makes us special, we have the best digital capabilities, plus we have the physical capabilities with them.
Brian, as you say, you've invested a lot of money, continue to invest a lot, you've made a lot of progress. At the same time, do you envision possibly a major acquisition in this area to really take you forward? Because you said the sky is unlimited in how far you can go with digital.
So we've done major acquisition would be off the table probably in a lot of ways because it just does a business model work with each other. But we have done an acquisition like in healthcare technology space. We did something to enable the payment side. So around payments, we bought back our joint venture on the merchant side a couple years ago. That was a $2 billion transaction, and now we've put $300 million in a new system to drive that. So we're always going to make acquisitions which complement our behaviors and also partner with companies or complement our capabilities and partner with companies. But the reality is we have 2.7 billion digital interactions in our consumer business last quarter. We have a huge business. We have 54 million digital customers that are accredited, and 41 million were active. We need to always be looking at what capabilities we need, and sometimes that's partner with providers and ideas that come in. But the reality is acquiring more customers is not what we're after right now. What we're after right now is driving the usage and the capabilities and people understanding what they can get from Bank of America's digital capabilities across the whole platform.
So just to that very point, Brian, when you come in every day or you go on your computer at home, how do you measure success when it comes to digital? What's on your dashboard?
So we look at the anchor product set in each client segment. So in the case of the consumers, it'd be the checking account and the core transaction account in the household. Investors, the core transaction account and their investment account. Commercial banking clients, it's a loan and what they call GTS, Global Transaction Services. So we start from the core account, and then we measure literally the usage of all the other products and services and how they do it. So, we know, for example, with our retail, which is our general consumer client base, how many of them who deposited a check last month, quarter, whatever, deposited mobile versus not, or at the ATM versus not. And what we're trying to do is drive that usage up, because once you have the checking account, the usage and the capabilities are what drives the satisfaction up. And then we look at, how many people have a card and have they gotten it digitally or not digitally with us. And because a digital execution to get a person to use their card and activate their card and spend on it is much cheaper than other ways of acquiring cards. So we look at it everywhere. Merrill Edge clients into the Merrill team, because in the day they're self-advised. Client like yourselves would have a self-advised account and might have a financial advisor. We want both sides so we measure that. So we measure literally numbers of customers, anchor accounts, and then every single product set that they can use, and then how they even use that product set that they're enabled on.
That was Brian Moynihan, Chair and CEO of Bank of America. Coming up, a look at the week ahead on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. South Korea's LG Energy Solutions trades this week after pulling off the second biggest IPO worldwide in the past year. The maker of EV batteries for the likes of GM and Ford is using the sale to spark a challenge for the top dog in the space, China battery giant CATL. Meanwhile, key Korean chipmakers Samsung Electronics and SK Hynix report earnings. South Korea also reports economic growth figures. Hong Kong and Taiwan GDP figures due too. Also on the data docket, Taiwan jobs numbers, inflation figures from Australia, New Zealand and Singapore, plus China industrial profits for the month of December. Now over to Danny Berger in London. Danny?
Thanks, Juliet. Well, the week kicks off with a big dose of politics. All eyes will be on Italy as the Italian parliament meets to vote on the new president. At the moment, expectations are that this could last 4 days, and it could be politically contentious as well, with the current Prime Minister, Mario Draghi, emerging as the front runner for president. Now, later on the week on Wednesday in Germany, the Bundestag meets to debate Germany's vaccine mandate rules. And on that very same day, as they're debating vaccine mandates in Germany, in the UK will have a lifting of all vaccine COVID rules. So COVID rules, things like wearing masks, testing upon planes, getting off of planes, those sorts of things as well. This, of course, comes at a time as well as Boris Johnson, the Prime Minister, faces increasing pressure over his rules and parties at 10 Downing Street during COVID lockdowns and calls for him to resign. Then finally, throughout the week, we'll get a good dose of earnings. European bank earnings kicks off with UBS, among others, and we have LVMH earnings as well. Now over to Romain Bostic in New York.
Thanks, Danny. Policymakers at the Federal Reserve meet next week. Investors writ large are expecting the FOMC to publicly provide a roadmap for a series of rate hikes that could begin as soon as March, as well as sketch out a timetable for shrinking the central bank's balance sheet. It would mark the first meaningful attempt to normalize monetary policy following almost 2 years of near zero interest rates and massive asset purchases in response to the COVID pandemic. The market reaction in anticipation has been relatively dour and comes just as the earnings season picks up pace. Earnings so far have largely disappointed amid concern about slowing revenue growth, narrowing profit margins, and tenuous forward guidance. More than 100 S&P companies are scheduled to report in the week ahead, including Apple, Microsoft, and Tesla. They are 3 of the top 5 weighted companies in the index. Also reporting next week, 3M, American Express, Boeing, Chevron, IBM, McDonald's, and Texas Instruments. David?
Thanks to Juliet Sally, Danny Berger, and Romain Bostic. Coming up, how big is the semiconductor shortage problem? How long will it last? And how can we fix it? We hear from the former head of Qualcomm, Paul Jacobs. That's next on Wall Street Week on Bloomberg.
Everybody's talking about it, the shortage of microchips.
Whether you make cars like Mary Barra of GM,
we saw significant impact with the semiconductor shortage last year. I would say every quarter it gets a little bit better, but we're not through it yet. There still is work to do.
or you make heating and air conditioning equipment like Dave Gitlin of Carrier.
We actually don't have the kind of buying power with the chip OEMs that maybe some other folks in other industries do, but I can tell you that we have met directly with the CEOs of major chip manufacturers. We've done unique arrangements with them that we've never done in the past.
And it's not just the buyers of chips feeling the pressure. The producers like Kurt Sievers of NXP Semiconductors are feeling every bit as much pressure.
The entire semiconductor supply chain is under pretty heavy stress these days.
Even Fed Chair Jay Powell's job has gotten harder because of the chip shortage, which he says is partly what's leading to the inflation we're seeing.
People want to buy cars. Car makers can't make any more cars because there are no semiconductors. So that's never happened.
So what's the solution? Congress is working on a CHIPS Act to get more investment in onshore production, which Congresswoman Haley Stevens of Michigan says is critical for the auto industry in her district.
Here in automotive land, one of the things that you cannot escape from is the chip shortage. We have got to pass the CHIPS Act.
But whatever the solution, just about everyone agrees that it's going to take time. Whether you're in the market to buy,
We still think it's going to linger into the first half of this year, and we should be farther out of it by the end of this year.
or in the market to sell.
This is going to get better through next year, but I don't think everything is going to be in balance from a supply-demand perspective through the end of next year.
And we turn now to someone who really knows this chip industry well. He is Paul Jacobs. He's now the chairman and CEO of XCOM, and he did for many years run Qualcomm. So Paul, thanks so much for being with us. First of all, give us a sense of how big a problem this is. Can you put your arms around how big a problem the shortage of semiconductors is right now?
Well, as you know, everything's being digitized. And so semiconductors are in almost every product we use, from home appliances to cars, and now even more so with electric vehicles. They're in the cloud, they're in our smartphones, they're in just so many things in our lives. And what's happened is that we had some shocks in the system, which became big because we had this notion of being very efficient, just-in-time manufacturing, lean manufacturing. So you didn't hold a lot of inventory on hand. And when there were blips in the supply, which happened because of COVID, these things spiraled out of control and became very, very big issues in the supply chain. And so you're seeing for big companies, some of them are able to get their components still. But for smaller companies, some of them are having a very hard time. Long lead times, sometimes up at as much as a year of waiting to get a part that you need. People have been raising prices. So all of these things are affecting sort of that innovation economy that the world depends on.
When you talk about just-in-time, did we underinvest globally? Did we underinvest in the capacity to design and manufacture chips?
I think that there's a lot of concentration in it, and there's only a few suppliers, so there's not a lot of diversity in the supply chain. But I think maybe to explain it a little bit simpler, if we think about it something close to home like toilet paper, when you think about there was supply of toilet paper and a pretty constant demand of toilet paper, maybe a little bit more because people were working from home, but you didn't buy a lot of toilet paper at your house because you figured you could go down to the store and get it. Now what happened, people got nervous whether they could actually go down to the store and get it, so they started putting more at home. They started buying more. And the system wasn't set up for that. So there was this surge in demand, and that meant that there were shortages. And that is part of the problem with the chip business. The supply is there under normal constraints, but now with these things that have happened because of COVID, and very interesting things happened because at first the demand dropped. Everybody thought the whole economy was slowing down, so the demand dropped. Then the demand surged because all of this work from home and all of the other things. So there was this ripple in the demand side. The supply side was basically there, but it's kind of like this toilet paper situation. Now people who have the ability are trying to hold more inventory so that they don't get hit by these ups and downs in the process. I would say, though, that it is important to build more semiconductor fabs, and it's important not just for the making of the chips, but also the packaging of the chips, the testing of the chips. But even beyond that, it's all the little components that go around it, the boards. I mean, we really, we have an issue where there were very few suppliers. There was a broad range of products out there and components that people needed. And all of this led to, a lack of resiliency, a lack of ability to adapt to these big shocks that might happen in the system.
Are we on a path, Paul, in your judgment, to coming out of that challenge? Because you mentioned the concentration. TSMC is the biggest producer, as I understand, of microchips around the world. They've just announced a major new investment in new fabrication facilities. We have Intel saying we're going to go back into fabrication, not just design. Are we going to come out of this with a more diversified portfolio of suppliers, or just 2 or 3 big ones getting bigger?
I think we're going to have mostly 2 or 3 big ones getting bigger. It's very, very expensive to build a new fab. It's $5 to $15 billion. It takes a couple of years of investment before you get that, you get a return on it, because you're starting to build chips through it. It is definitely true that the big guys are going to invest and build more fabs, and they're going to build more fabs in different places as well. So we'll get some geographical diversity. But then you worry, are we going to have this boom and bust cycle where right now there's too much demand for the supply, and then supply gets overbuilt, and then all of a sudden there's too much supply for the demand. Now, that may not happen here. There's people on both sides of this issue because, of course, as I said earlier, digitalization of things is happening. Electronics is getting embedded in so many things. New things are coming up. Obviously, work from home caused a big demand for computing products, the cloud. All of this AI and machine learning stuff is creating it. Digitalization of automobiles and factories, and I mean, just so much stuff is going on that can create more demand. So it's not clear that this is going to be an oversupply situation in a couple of years, but that has happened in the past in the semiconductor industry.
Well, pursuing that very question of boom and bust, I mean, if you look at the global demand in terms of value for microchips over the last 10 years, it's been its own form of Moore's Law. I mean, it's just gone straight up geometrically, not arithmetically, geometrically. Do you expect that to continue, or does that flatten out somewhere?
No, I think that we're going to continue to see a strong demand because not everything is digitized yet, and so there's going to be more and more going into different things. And as we said, artificial intelligence and machine learning is now going into a lot of things. The cloud is expanding, and it's not just the cloud in big data centers that are located somewhere out in the, near cheap power and so forth. Now there's this thing called edge computing, which my company is depending on, which means pushing portions of that data center out around the landscape. So there's going to be distributed computing all over the place that you're going to be able to tap into when you want to do things like strap on your metaverse headset and get into that virtual reality and things like that. The stuff that people are talking about is future applications. So that is going to create continuing demand. This idea that we're going to spread the computing out, and then there's still crypto, all of these things that demand chips. So I think demand is going to continue to go up.
Here at Wall Street, we like to talk about investing a lot. What does that tell you to an investor? Is this a good business, chip design and manufacture, or are you better off investing in companies that are using the chips?
Well, right now, the companies that are using the chips, many of them are having a hard time getting access to them. So you'll see impacts on their earnings right now. The ones that are supplying, hey, it's a great time. There's shortages, they can raise prices. It's not fun dealing with customers that are upset that they aren't getting their chips, but from a financial standpoint, they're doing well. I think what you'll see, though, is that the companies that are using the chips are going to become more creative about how they do things. They're going to try and despecialize so that they're going to use more commodity components, and that means that they won't have to go searching for, I'm missing this particular little piece over here that was special to me. I can just use something that everybody's using, make it easier. So those are the companies that I think they will come out of this, and they're looking bad right now. So they're down right now because their earnings are down, but they should recover as the supply comes back. Now, the big guys, I mean, TSMC has been on a roll from the early days when we started using them at Qualcomm to outsource our manufacturing of chips. And they're in a very strong position because they're ahead on technology. Their technology is extremely good. It's extremely leading edge. And so much of the world's semiconductor supply at the leading edge comes out of TSMC, which of course leads you to also be concerned about geopolitical risk associated with that too. And that's why some of these nearshoring efforts where fabs are going to be built in the United States are so important.
Paul, this has been very helpful. Thank you so very much. That's Paul Jacobs. He's the chairman and CEO of XCOM. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're going to wrap up the week again this week with our very special contributor, Larry Summers of Harvard. Larry, welcome back. Good to have you here. We've talked about the Fed. We've talked about inflation. The Fed has said they're going to tighten because of the inflation you've been warning about for some time. We actually get a decision next week. What do you expect the Fed to do?
I think they're going to be signaling that a tightening in March. I hope they'll be signaling as rapid as possible an end to QT. We got an economy that's looking like it's above the speed limit and it's going to have to slow down. And the Fed's got a very delicate operation now in slowing it down. The delicacy of that operation is underscored by the turbulence in asset markets since the beginning of the year. It's underscored by the softness in some kinds of measures of consumer sentiment and consumer spending. But if we're going to have maximum employment and maximum growth over time, we're going to have to control the pace of the growth of total incomes so that more of it can go into more employment and more output and less of it into inflation.
Larry, as you look at the various indicators, are you concerned at all that maybe we're too complacent about the Fed's ability to do this? The markets, you should say, have been turbulent. They're reacting. At the same time, you look at the 5 years, they're still at like 2.12%, something like that. And also, the financial conditions have not really tightened much. Is that because we're just so confident the Fed can do this without really roiling people, or are we underestimating the size of the problem?
I think the gravity of our situation is still understated. While the term transitory has left the policymaker discourse, the idea of transitory inflation is still very fixed in their minds. There's still a belief that with very limited monetary actions that have not taken full effect, we will see inflation slow to the 2% range by the end of the year. That certainly could happen, but it wouldn't be my bet, given the tremendous tightness of labor markets, given increasing signs that China is going to be a source of bottlenecks for quite some time to come, given increasing concerns about oil prices, given that there's a lot of housing inflation that still has to feed through the system, and given how remarkably low real interest rates are, I don't think that it's the best bet that inflation is going to be coming down to into the 2% range or the twos by the end of the year. And so I think complacency is not appropriate. And I think the evidence is that inflation's at rates lower than 7% don't exit the system without very substantial economic turbulence. So no one's pulling harder for the Fed to strike this balance and get it right than me, but I think it's not going to be an easy one.
So Larry, President Biden had a quite long, almost 2-hour press conference this week. And in the course of that, he basically said it is the Fed's responsibility to do with inflation. He talked about the economy. What did you make of what President Biden had to say about his leadership of the economy?
Look, I think President Biden is right to take pride in the fact that more people are employed than anyone would have expected on the day he took office, despite very substantial disease threats. Frankly, I can't understand for the life of me why the administration is so obsessed with meatpacking. Meatpacking is a entirely trivial and unimportant issue with respect to inflation. It is inconceivable that tossing $1 billion, as the Agriculture Department is, in the general direction of creating an extra meatpacking plant is a good use of taxpayers' money or is going to happen. So I don't understand why the President of the United States keeps talking about that. I'm glad to see him recognize and emphasize the independence of the central bank. And as I said on your show last week, David, I very much hope that his new appointees to the Fed, when they have their confirmation hearings, will take the opportunity to underscore their recognition that the most basic responsibility that the central bank has is a stable currency and price stability and the avoidance of inflation. That's not something that's been in any of their writings prior to this point.
So, Larry, when you talk about meatpacking, I naturally think about competition policy and antitrust law. You have something of a dispute, perhaps going with Paul Krugman, your former classmate, your friend, over the role of antitrust. And we've heard from President Biden and others that really antitrust enforcement is a key ingredient in fighting inflation. How big a difference do you really have on this subject?
Should we have substantially enhanced antitrust in the United States? Yes, we absolutely should. Is it harmless and normal politics to take advantage of concern about high prices to drive political energy behind that competition policy? Yes. Does it make sense to suggest that antitrust policy can in any important way reduce the inflation rate over a horizon of a couple of years? No. That is not supported by economic science. I'm also worried about the antitrust doctrines that some of the Biden appointees have put forward. Lena Khan expressed a concern that perhaps when two firms merge and they're able to produce more efficiently with fewer people, that should not be counted as an efficiency. There's been a lot of talk about introducing considerations other than lower prices for consumers into antitrust, protecting small business competitors, for example. That kind of stuff is, frankly, promoting of higher prices and works in the wrong direction with respect to inflation. Right. The most important thing we can do with respect to competition policy is accept lower priced goods from abroad. And resistance to protectionism, active trade policy, those aren't things we hear about from the administration. So, yes, I am all for competition policy. Yes, I think antitrust in our country has lagged, but it needs to be based on lower consumer prices.
Larry, an important development this week, potentially important, I believe, is the paper that came out of the Federal Reserve about a central bank digital currency, the possibility of that seeking comment over a 120-day period, laying out some of the possible advantages and some of the possible risks. How important do you think this development could be?
Potentially, it could be seismic. I was glad to see what I judge to be a thoughtful, cautious approach by the Federal Reserve. I think the right way to think about this is in terms of what will give us the most efficient payment system and what will be most enabling of an economy that works for businesses and works above all for consumers. There's been a certain amount of hysteria that because China's going to have a digital currency, we have to have a digital currency in order to protect the role of the dollar and that kind of stuff. I was glad to see the Fed stay away from the hysteria about the role of the dollar and to be approaching the question in a deliberative and thoughtful way.
Larry, let me sneak in one more, if I could here, please. A couple of weeks ago, we had an outrage of the week from you about the patterns of investment from some of our public officials, whether at the Federal Reserve Board or up on Capitol Hill. We now have perhaps a development where the Speaker of the House, Nancy Pelosi, apparently has backed off of her resistance to a broad ban on that. What do you think should happen?
I was glad to see it. I think we need to scale any suggestion of impropriety by public officials out of our system. That means not trading in individual stocks. That also means not hearing something and calling your broker to do anything, even selling mutual funds and the like. People should be able to adjust their financial positions, but only well in advance, so that there's a reassurance that insider information is not coming into it. And there should be rigorous rules in both the executive branch, the Federal Reserve, and the Congress. And I think it's an area where it's appropriate for confidence to look at things.
So an outrage of the week that may be a little bit less outrageous going forward, we hope. Thank you so much to Larry Summers of Harvard, our very special contributor on Wall Street Week. Coming up, Omicron strikes again, and this time it hits our four-legged friends. This is Wall Street Week on Bloomberg. Lions and tigers and bears, and even hamsters. Oh my. Every one of us is dealing with COVID in one way or another, whether it's worrying about our hospitals.
We're still seeing a fair number of infections per day.
Or whether our kids can go to school.
We have to keep our kids in school. We have to have supports and triage and tutors and other ways of doing business.
Or figuring out when we should go back into the office.
As more people get vaccinated, we keep bringing more back. We've got a lot of work to get those back.
But that's all about us. What about the other creatures that share the planet with us? What about the tigers and pumas and minks and, yes, even the hamsters? Well, it turns out that a lot of them can get this virus too, and they don't even have the option of getting the vaccine, much less the booster. A year ago, it was a crisis over mink farming in Denmark, which brought the Danish Prime Minister to tears when she ordered millions of the little furry creatures destroyed.
Det har været følelsesladet for dem, og det også for mig.
Now we learn that lions and pumas in a South African zoo have contracted COVID, apparently from the people who work there. Fortunately, they were treated and they recovered, which is more than we can say for the poor hamsters over in Hong Kong. China is pursuing a vigorous, some might say ruthless, policy of zero tolerance of COVID. So when a local pet shop worker, a customer, and 11 hamsters tested positive for the Delta variant, the Hong Kong government ordered all hamsters imported since December 22nd euthanized, despite the lack of really clear proof that humans can get COVID from hamsters. But there may be another way. Since the 18th century, in a small village west of Madrid, on the eve of San Anton's Day, they purify animals from disease. Well, how do they do it? They take a group of horses and ride them through bonfires, which may or may not date back to the days of the plague. And if it seems a bit medieval, then again, doesn't a lot of our response to this pandemic? It sure does for those poor hamsters. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.